Hey, hello everyone. Rod Crandall here, Chief Integration Officer at USAdvisors Insurance. Appreciate you being here today. You're catching us on our Coach's Corner. This is a monthly call that we do on the third Thursday of every month. Hopefully you've tuned in the past. Thank you for being here. We do record all of these sessions. So if you've missed one or you want to go back and review these, certainly reach out to me or George or Andrew, and we'll make sure to get those to you. So today I'm very excited to have some special guests with me today from John Hancock. You have Kevin and Mike. We're going to do a little bit of a dog and pony show today, and really hope that in the next 45 to 50 minutes, you can walk away with some good ideas, some actionable ideas to really go help some clients and drive some revenue to your practice. So you note that the title of this talk is Why Now is the Right Time for Wealth Transfer Planning. And we're going to talk a lot about that today. If you take a look a little bit at our agenda, we're going to talk a little bit about why I believe this might be the best time. We do have an estate tax sunset coming up. We're going to hear a lot about that from Mike. Just in general, I would ask you, what do you think's going on with taxes? I don't think they're going down, they're going up. And if you look historically, we're in a historically low income tax place. And what I find is a lot of the clients that I'm helping are oftentimes trading off the cost of taxes for the cost of insurance. And it can often be a very favorable trade-off. And to the extent that taxes get higher, that becomes even more appropriate and even a better story. So with these things, we're going to talk a little bit about where are those planning opportunities. We're going to highlight John Hancock. I mean, I'm sure there's not one person on this call that's not at least familiar with John Hancock. They're one of the best out there. They have some really good niches, some really great products. And we're going to hear a little bit about where they shine and want you to keep them in mind when you have the right kind of client. Now, if you've been in these coaching calls, you know that we do like to share with you product ideas, but more than anything, we want planning ideas. And what that really means is that we have to have great conversations. So you might have the best idea, you might have the best product, but if you don't have the right client and you don't have an appropriate conversation with them around what insurance does as opposed to what it is, you are very likely not going to have a lot of success here. So we want to really be able to help you identify who to talk to and help you position how to talk to them. And then we also have some tools and some resources that we have available for you. And so as I indicated, I came into this business in September of 2000. And with no joke, as I sit here today, I personally believe that we are literally in the best time ever to be in the life insurance business. And it has a lot to do with taxes, in my opinion, it has a lot to do with these record debt levels, right? Which is very likely meaning that we're going to have to get revenue from somewhere. And generically speaking, it's going to come from our best clients. And our best clients then have a very serious liquidity issue. They have a serious taxation issue. And if we can use a specially designed asset class called life insurance, and in particular, if we can remove it from our estate entirely, we can put an asset that's non-correlated, guaranteed, and income and estate tax free to our heirs. And you might be very surprised how big a checks you can get from your clients when they really understand that we can pay a lot less in insurance costs than we can pay in taxes if we plan for things appropriately. And so this 10-year rule for non-spousal inherited IRAs, this is maybe the biggest reason for life insurance right now. I know a number of clients that have $1, $2, $3, and $4 million IRAs, and you probably do too. They're probably really proud of those IRAs, as they should be. And now they have the biggest tax bomb that I've ever seen in my life, not only for themselves, but to the extent that it goes to the future generations, the non-spouse, right? If I inherit a non-spousal IRA, it's the single worst asset on earth for me to inherit because I've got to get it spent down in 10 years and it has to be at my top marginal bracket. And so right there is a huge opportunity for people who can understand. But you go to those people and say, you should buy a large insurance policy. We have not had the right kind of conversation. And we have to have them determine, are you aware of this? How do you feel about this? Because the number one thing you'll get is, I don't need life insurance. My response to that is, no, you don't need life insurance at all. But if you understood how it works and how we can appropriately use it as an asset class inside of your portfolio, you wouldn't be asking me, should I or should I not do it? It would be, how much should we do, right? And so we have to have education in the right context so we can get consideration to implement the very powerful tool called life insurance. And so I, again, happen to believe that we're in the best time ever. One thing that's not on this screen is interest rates. When I came in 2000, you could basically sled down the interest rate hill for 20 straight years. Well, that hurts insurance companies because of how much money they have to have in reserves, right? Well, now they have a little bit more juice, if you will. And so their general accounts are earning more. And so the product designs are more robust, et cetera. So I really do believe that we're in the best time ever to be in this business. And as we indicated, if you're going to do this, you're going to have to do it on purpose and with intention. If you've been on any of these calls, you know that effectively what we sell is the intentional integration of insurance into a wealth advisor's practice. Yes, we sell products, but that's the last thing we do. The product selection and implementation is like step 10. Okay? What we need to do first is we need to identify who is the right kind of client to have a conversation. Once we know what client we want to talk to, we have to determine how do we appropriately find the entry point. You know, you don't generally just call your client and say, hey, do you want to talk about life insurance? That's not going to work that well. What about in the financial review? Right? What about the quarterly reviews that oftentimes are scheduled for an hour? The first 50 minutes is BSing around vacation and kids. The last 10 minutes is here's your performance and let's move on. Well, maybe that's an opportunity to say, hey, congratulations. Look how well your portfolio is doing. Would you like to have a conversation on the one or two things that could potentially go wrong? Right? Just be one example. But we have to have the right kind of client. We got to figure out how to bring up the conversation. And then we have to figure out what's important to the clients. We need to be able to help them define what their risks are, but more than the risks are really the consequences. How would you feel about the double dipping of a long-term care event on your retirement portfolio, for example? How would you feel if 25% of your portfolio goes to taxes? Right? You start asking people how they feel, now you're touching their heart before you're touching their mind. And when you do that, people don't buy insurance because they love insurance. They buy insurance because they love what insurance will do for them. And that's why we have to have that right kind of conversation. Right? And we ultimately have to have permission from a client to be able to educate them and educate them without skepticism effectively and in the context of the financial plan so that they can make a good decision. I happen to believe our number one job as wealth advisors is to motivate our clients to operate in their own best interest. And relative to insurance, that often does not happen, in my opinion, because they may be hiding from insurance agents, hiding from insurance companies. You yourself, as a wealth advisor, might be hiding from this topic. Right? And so what I would encourage you to do is that if you're not comfortable with that, lean on us dramatically, not only in sessions like this, but I happen to do a lot of joint work with wealth advisors and some of those that are on the call. And so if you know you have the right kind of client, but you're not quite sure how to appropriately do that, consider utilizing me and we'll help you on a joint work basis. At the end of the day, if we can't help our clients understand what insurance does, okay, they're not going to buy. Nobody wants insurance. They want to provide a supplemental income. They want to equalize an estate. They want to inject liquidity. They want to be able to buy out business partners. Right? We don't specifically need insurance to do any of those things, but we ask them what they need, and then we ask them, what is your plan for funding that? And then what happens if something goes wrong? Like long-term care, I often hear, well, I'm going to self-insure. I have $5 million. Okay, well, where is that money going to come from? And what happens if it occurs in a down market? And how would you feel about redeeming shares in a down market? Right? These are the kind of conversations that I believe get us to the promised land. So with that, what I want to do is I want to introduce Mike Walker, and he's with he's part of the advanced markets team at John Hancock, and he is going to share with us a couple of ideas and educate us a little bit further on the rollback that is scheduled to occur in, I guess, January of 2026. So Mike, take it away. Thank you for being here.
Absolutely, thank you. And can you just confirm you can see my screen here?
I can. Or? Yes, sir.
All right, we should have the view there then. Great. So yeah, thank you, Rod. That's a nice intro, and I appreciate that. You know, the way you frame that, because I do think it's true that you know, you have to touch the client's heart before you get to their mind, and you know, really, yeah, product is at the end, and that's kind of what we do in advanced markets is here at John Hancock is we try and you know, help people conceptually understand what they're doing, and then you know, we can help them appropriately select the way to go. So what we'll talk about today is some of the things we're seeing now and what's coming up a little bit in a couple of years. So, excuse me, the PowerPoint's going ahead of me. So just ask everybody here if they can think to themselves, where will they be 931 days from now? I want you to think about that for a minute. On the macroeconomic side of what we all really kind of understand is that we've had inflation, significant inflation over the last 18 months. There's volatility in the market. There's a tightening of monetary policy. I think the Fed came out yesterday and said they were going to hit the pause on the interest rate. But the comments post that announcement were that they're thinking of raising interest rates again at the next meeting, which is kind of interesting. It's like they almost paused the movie and then said, hey, we're going to come back and watch the same thing. So we don't really know where they'll go. But from our standpoint, it's like we still have to plan around all this, and those macroeconomic forces. We talk a lot about what's going on domestically and geopolitically. The fact of the matter is that the deficit has increased. You can see that chart. The federal debt held by the public is sort of going increasing. I don't want to say exponentially, but it's getting up there pretty high. But we have a $1.4 trillion deficit. So matched against revenues, we are going to see that deficit increase. So the idea is that eventually the federal government is going to have to raise revenue. One of the ways they raise revenue is through the estate tax and the exemptions, the gift tax exemptions that are available. And so that's why I want you to think of 931 days, because if any of you have done the math or Googled it really quickly, what you know is that in 931 days, it's January 1st, 2026, where the state tax exemptions are going to change. So what does that kind of mean? What you're seeing here is, if anybody's been to Disney World, you might know what this is. This is the Summit Plummet. The Summit Plummet is it's a water slide, which you will not find me on unless my kids dare me to do it. And what that is, you go from 0 to 60 in 2.73 seconds. And really what you're wearing is a bathing suit and probably screaming on the way down, right? So that's the Summit Plummet. If you ever see it, if you go to Disney World, have fun, but really don't expect to see me up there. The same kind of thing is happening in those 931 days. The probably most happy institution right now, sort of legislatively in 2026, is going to be on January 1st is going to be the IRS, because right now what you see is we've got an exemption of $12,920,000 per person. So for a couple, you double that. So we're in the highest exemption we've ever seen from an estate tax standpoint, from a gift tax standpoint, from a generation skipping standpoint. So what happens in 2026 is we're doing a little bit of math there, because it is tied to inflation. It's scheduled to go back to 5 million, but it tracks with inflation since this law came about in 2017. And so we kind of estimate that it'll be around 7,720,000. And it's a really interesting type story, because 2021, you had about 2,500 estates that paid taxes, right? The majority of those estates were probably in the $20 to $30 million range. If we go back to an exemption that's lower, you're going to bring in a bunch of estates in the $10 to $20 million range that are now going to have to contemplate paying an estate tax. So it's something that a lot of people don't know about, as they're planning. I always say the $40 million estate knows they have a problem. The $20 million estate maybe doesn't know they have a problem just yet, but it's embedded there, and they have to start thinking about this now for a variety of reasons, of which I'll tell you. So when we look at it, looking at this kind of graphically, we say, wow, there's that Summit Plummet, right? Looks very familiar. And do you really want to be going on the day of January 1st, 2026, from 0 to 60, 2.73 seconds, you're going 0 to 60. From our standpoint, what that means is all of a sudden might be saying to a client, hey, if you make a big gift this year, you have to pay a gift tax, or what you had planned for estate taxes has now increased to a point where we have to do planning, and clients are older. We haven't preserved their insurability from between now and then, and they may not have as much flexibility. So a lot to go into in designs between now and then, now in 2026. I can probably assure you that at the end of 2025, if nothing changes legislatively, that we'll all be very, very busy with clients, and they'll have significant concerns for those clients, and even clients, younger clients that may have a $2 to $5 million estate. If you project growth on those estates over time, this exemption now is something that this exemption decrease is something they have to think about. So, that's what we're looking at right now. And this is just a chart of the, estates paying estate tax. It looks kind of low. It's like 0.1%, but that's at 2,500 to 3,000 estate taxes, estates in 2021. We're basically going to double that to 6,000 estates in 2026, maybe even a little bit higher, that are brought into the federal estate tax system and have to pay estate taxes. So, when the exemption, which is the teal looking line there, I guess, aqua, when that, I'm sorry, that's the orange line. When the exemption increases, you see the percentage of estates paying taxes go down. When those exemptions will decrease, you see it going up. So we really have a problem where, almost from a capacity sort of functionality standpoint, where we're going to have to help all these folks. Like, we need to be planning now, because we do not want to get the call on, like, say, like December 2025, happy holidays, let's go, let's put a plan in place. Everyone's going to be at sort of like maximum levels of effort there to try and get past this, if we even get there, though, because one of the number one questions that we always hear is, will the sunset actually occur? Well, I don't have a crystal ball, and I can't predict the future. I think I have to say that for almost compliance purposes, but we have opinions, right? The thought is that once you give something like a tax benefit away, to folks, that you'll never take it back. It's like, taking a gift back, right? You never do that. We're in a different kind of, I think, environment when it comes to estate tax, estate exemptions, gifting, and all that. In that, like, can you decrease the exemptions to increase revenue? And that's kind of the idea of how the estate tax works sometimes. I know people kind of think of it as sort of this, like, kind of, rich people don't want to pay the estate tax. Other folks feel that people should pay their fair share. Whatever it is, it's not really like that in my mind. In my mind, what we see is, the policymakers have to project revenue. Basically have to try and balance the budget. We know that's fiction. We know it's on paper. That's not going to really come about, but they still have to project it like that. And so the estate tax exemption is something that they can use to say, okay, we will, we can project revenue if we do something like sunset the estate tax exemption in 2026. That projects revenue, and hence allows them to pay for the plans they want to put in place now. So those are the types of things that I think people should think about. Is like, will it decrease? Yeah, there's some, I think, potential there that it will decrease, and there's always the potential that our folks in Washington, our friends there, come in and say, hey, we're just going to put it to this number. And we don't know what that might be, but in previous green books that came out from the administration, they looked at a $3.5 million exemption per person. So will they reset to that? I don't know, but you definitely should plan around that. And if it is decreased, well, that even adds to the power of, say, making a gift now before you lose that increased exemption. Other things to keep in mind is that some things are also sunsetting. Some individual income tax provisions will change, might change the brackets a little bit. That 199A pass-through exemptions could change. And, who knows what's going on economically, politically in the next 18 to 24 months. Let's see, because obviously you have maybe different administration, different Congress, priorities change, budget ideas change. So you might see a change. Will it increase again? I don't know. People feel pretty happy with where it is right now from a gifting standpoint, and for estate taxes and planning. We have a lot to work with. So who knows if that'll change, but we'll see. My guess though is that they will keep using the estate tax exemption in that revenue projection type framework to use it as a tool to pay for plans today. So kind of keep that in mind. But if we just look at an estate value, right, in 2023, let's just kind of look at these numbers for 1 second. Today, your lifetime exemption is 12,920,000. Let's say the estate's 20 million. Taxable estate after you do the exemption is 7,080,000. Straight math of 40%. Your estimated tax today is 2,832,000. Let's assume that we grow that a little bit on by December 31st, 2025, when everyone's popping champagne bottles, the lifetime exemption, we're making an assumption here, will increase to about 15 million. Taxable estate will also increase. Your 40% tax rate there, you'd have about a $3 million estate tax. That's the middle column there. The very next day where the party extends into the IRS offices is when you've got a $22.4 million estate, same estate the next day, your lifetime exemption decreases to 7,720,000. Overnight, your estate tax has gone from 3 million to about 5.9 million. So, just kind of from a math standpoint, we have to think of that for these folks that are planning right now, because, in that 10 to $20 million range, you've had almost $3 million more of estate tax. Hence, we need to cover them. And it's better to get it done now while they're younger, have insurability. Any number of things can happen. We want to get in front of that right now. So the story doesn't quite end there, though, with just simply the estate tax. You don't sell to the estate tax, as Rod mentioned. You kind of, the emotional factor of, what do you want your legacy to be? What do you want your, what kind of liquidity do you need when you're, when you're passing assets to heirs? Creditor protection aspects and trusts have become, almost probably say like 1 or 2 in the priority of clients to say like, yeah, I really want my assets protected. ILETs, irrevocable trust can do that and help them out. And, I think as you heard from my last slide, tax laws are unpredictable. Who knows what's kind of going to happen? So, and again, we want to get in front of those clients so that they have, the ability to make choices now that could be taken off the table later. So, the idea for clients a lot of times when we're talking about putting assets in trust and irrevocably parting with those assets for the future generations is the tension between control and tax. People do not like to give up control of their assets, their businesses, their money, but they dislike paying taxes. And where do they fall on that level of like, well, if I give up control, will I save some money in taxes? So, that type of conversation has to happen, and that happens on the level of again, kind of the emotional level, not the intellectual, mind level of like saying, well, let's just pick a product. Let's figure out, what you want to do, how you want to go about it, and we can show you the way to go. So really 2 options that the client have right now when it comes to figuring this out. The first option is just jump in and make the gift. You can then use those gifts inside. That's not a picture of me doing a belly flop, by the way. Just want to make that clear. You don't have to, when you're making a gift like this, and the client really, I think, should think about how they're planning for the future and the way they're positioning things, rather than they're just irrevocably parting with the money. But once they do make the gift, then it becomes up to us to show them the best way to to deploy that gift. How can we provide the liquidity, the coverage for estate taxes, and can we show them that life insurance makes sense for them? We do that in a couple of different ways. We have a gifting output that we can show that we pair with the product they've selected to show them here's the impact of the estate taxes. We can show them the internal rate of return on the policy versus a taxable investment to say, hey, yeah, you're making sort of a sound economic decision here. And oh, by the way, you are covering for potential estate taxes and those next generations. Essentially, it's like, can we show them a positive outcome for themselves and their family as the wealth transfers down to the next generation? And that can be a combination of investing in the trust and even still running a business. It depends what they want to do. There can be a number of ways they can go. So the second option is, okay, if I don't want to make a gift now, and they're on that side of they don't want to give up control, why not use a financing type technique to pass assets along to the next generation? And a lot of times when people hear financing, they immediately think of premium financing, which is fine. But with that rise in interest rates, we have seen third-party commercial premium finance move a little bit to where people aren't people aren't using it as much this year as they may have in years past as those interest rates have increased. So what we do is a financing technique is not simply third-party premium financing. It's looking at things like gifting, split dollar, private finance where you use your own assets, maybe even transferring business assets into a trust and leveraging those assets to pay for premium and increase the liquidity and also reduce the taxable estate so that you can sort of dovetail with a reduced taxable estate, a life insurance policy, and an asset outside of the estate inside a trust that allows folks to even sometimes still work and keep the control of the business in their hands. So there's a variety of ways to do this. Now, when you say a variety of ways, and it's like, I think sometimes people think, wow, you're going to send me 6 different ideas and it's going to be a lot of paper and a lot of things to go through. Well, yes, eventually, but no, what we've done is we've boiled down all different types of techniques, gifting, financing, however many that you want, and we basically put a summary on one page, and then it allows you to look at it, and the client can then go explore which way they want to go more deeply. So you can tell me, okay, we dipped our toes in this, and now we also want to look at this technique we want to go into more of a deep dive on that technique. So that's the idea of showing this, is not just to overwhelm people with ideas and paper. It's just to say, okay, here's a couple of things to look at, a short summary, 1 page of a few different ideas, and then we go further with the ideas that the client wants to explore. So been pretty effective in using that, and we expect to get busier, of course, because we know there are more estates out there that are going to be contemplating paying the estate tax. So pretty good idea to look at. So what is the kind of the building blocks of flexible design? And then really that's what we want. We want flexibility. So for instance, with trust language, a lot of times folks say, well, I will just get my trust. There's different websites, and you can certainly Google life insurance trust and find any number of places where you could download a PDF and there's your trust. But that really the way it works? No, we definitely encourage people to engage with an attorney, and that attorney, again, talking on that emotional level, can say, what do you want? Like, how do you want to do? So that might mean adding spousal access language. That might mean adding spendthrift language for children that you may think need more time to mature into having those assets in their hands. And then we talk about ownership. How are assets going to be retitled? You may gift assets to children directly, or you may put them in trust or whatever you might do. And then at the end is when we talk about financing techniques. And just so that's kind of the idea of, like, we all try and like wrap it together and show the client some good ideas as they go forward. One thing I would definitely emphasize too is we're hearing a lot from the estate planning community out there that there's only so many estate planning attorneys, And, with this change in the exemptions, a lot of people are going to need to access those folks out there. And so for that type of idea, it's like, let's engage with those attorneys now, get these building blocks, get these trusts built, talk about ownership and things like that, so that we can, be well positioned to move ahead in the future as the clients make decisions. So with that, thank you for listening to me. There's our number here at Advanced Markets. We have attorneys on staff, we have consultants like myself, and we have a number of educational marketing type pieces that are available to clients to use for estate planning, business planning, and other techniques. So I think with that, I'll hand it over to Kevin.
It's beautiful. Thank you, Mike. Yeah, Kevin, take it away. Really appreciate you being here. Kevin is our quote regular RVP, so he's sort of our first line. And then Mike obviously is in the advanced markets, and these guys do a great job. So Kevin, the floor is yours, buddy.
Can everybody see that?
Yes.
All right. Before I get started, I just wanted to, well, I don't know what's, all right. Rod, kind of like you, I've been in the business for a while, and I always think back to how many times the exemption has changed. And I reflect back when I started in the business in the late 90s, what the exemption was. So just for educational purposes, before we kind of get into the prepared remarks, the exemption credit was $675,000 when I started in this business. And so basically, I live in Southern California. If you had a home here, you were likely going to have an estate tax. And I think Mike brings up some really important things to consider, that timing is of the essence, and that we are in an unparalleled and unprecedented time to gift assets away. And we can do it smartly with control and trust language that helps protect the family and the grantor. And so it's important to remember that. Also, what's interesting to kind of think and reflect on is how many times the exemption credits changed. And actually, in one year, we had no exemption credit. And the famous person that died in that year in 2010 was George Steinbrenner, the owner of the New York Yankees. And he timed life pretty perfect as it relates to exiting this world, because on July 13th, he passed away. And I think we'd all realize his estate was valued in the billions of dollars as an owner of the Yankees. And so it's just important to remember that we're going to be in times here where the exemption credit is likely going to come down. It's going to affect a lot more Americans, and something that we need to start dialoguing and talking to them about. So Rob, before I get started here, why don't we just talk a little bit about the case you've been working on? Mm-hmm. I think my promise to you as a wholesaler and as a regional is to work with you in a way that allows us to have at-bats, but you have to marry in the world of product selection with the world of underwriting. And there's lots of good carriers out there. We're all competing for the business. But as you started to talk with the Nelson family, talk to me a little bit about how product selection was made, and that will lead into our prepared remarks here around Protection UL.
Yeah. So at the end of the day, we were trying to implement a $20 million second to die policy. There is not that many carriers in the industry to begin with that have a second to die product. We certainly wanted to be a big, beautiful carrier. So candidly, we looked directly at John Hancock and Prudential. And what we were really doing was generically comparing what I would call a fully guaranteed solution with Prudential to age 121 versus your solution, which was guaranteed, I believe, to about the mid-90s, but way better priced. And so the conversation was, which company should we use? And the things that we talked about were risk versus reward. Everyone wants to pay the lowest number on the page, even I do. But what if the lowest number on the page comes with a lesser guarantee? Then what? Well, you really look at the math, and you guys really outshine Prudential quite a bit because you were way cheaper. And when you start thinking about it, which is what we did, we said, well, what if it takes 10 years and something's going on with John Hancock and maybe the crediting rate is off? By the way, we discounted the crediting rate in the beginning. Okay, so we're already being as conservative as we can. But if we get 10 years of saved premiums and we have to make up some premiums, we started to get very, very comfortable. And in fact, the wealth advisor who I was partnered with was more comfortable with the variability than I was. I tend to really value guarantees, but like any kind of guarantee, you've got to pay for that guarantee. And do we really need the guarantee? And the answer we all kind of came to is, no, I don't think we need the guarantee because John Hancock's a good company. We have significant savings, and we're going to find out. So I'm very comfortable. The clients are very comfortable, and the wealth advisor is very comfortable.
Yeah, thank you. So $20 million, we've got a great case. It's paying next week about $180,000 of revenue. And so super excited to help be that provider of that solution. For today's purposes, I want you to look at this slide and say protection UL, but you could also put an S right in front of the U, which is what Rod was just talking about, and say protection survivorship UL. But for the purposes of the conversation today, we have to take a step back and go to 2008, 9, and 10, and what the insurance industry was facing at that time. What we were facing is declining interest rates and persistency in low interest rates, and all-time high reserving requirements and costs to reserve for guaranteed products, no lapse guaranteed products. And really, there was a handful of carriers. Almost everybody had a no lapse product at the time. And really, it was just a term to 121 sale where the carriers started to strip out the value, the flexibility inside the contracts, and say, here's a term to 121. There's not going to be any cash value for your clients to use or provide flexibility. And we're going to basically have a commodity war on price. And Hancock took a pretty aggressive position and really led the industry in saying, we're going to step away from the true 121 guarantee and create a product with flexibility and guarantees, but also upside potential through a crediting rate. Now, when we did this, I wasn't at Hancock at the time. I was with the competitor, actually. And what was interesting is that the interest rates were low, and we were going to a product that was crediting a relatively low interest rate. So you'd say, well, why in the world would I want to buy a product that is at historically low interest rates that has a fixed crediting rate into it? Not a variable rate where you could participate in sub-account selections, not an IUL where you could have a cap and a floor, a true fixed UL. And I think that's what interesting is that we went to the market first, and then all the other carriers started to adjust their GUL pricing, and we were out ahead of the curve and had a product that stood the test of time. So if you think about it, we're going to have industry-leading premiums. Rod talked about this. You could pay more for a guarantee that's longer, but should we always do that? There's going to be clients that see the value of cash. They see the value of a strong guarantee out past life expectancy. And they also see the flexibility that those current assumption values create inside the product that are in excess of just a normal guarantee. And we're going to talk a little bit about our unique general account investment strategies, which helps us maintain that interest rate at a competitive rate. We also have lifetime LifeTrack billing. This is going to help the clients adjust their premiums that are necessary given the interest rate inside the contract over time. And we'll look at an example in a second. Lastly, I just want to remind you that we've got Vitality Plus, which is our lifestyle benefit discounts inside our contract that reward people for healthy lifestyles. So there's lots of levels within Vitality that help your clients either pay less or help their cash value grow more by doing things like regular exercise and going to their doctor. And right now, to incentivize you, the agent, we're offering a really competitive bonus when you elect Vitality to your commission, and Rod can talk to you more about that, but a 12% potential increase to revenue simply by allowing your clients to participate in Vitality and all the amazing things that go along with that. So it's nearly impossible for a GUL to outperform its guarantee. What's important about that is that it's no cash value. There's just a term to 121, but a protection UL policy can outperform its guarantee through that current assumption performance. If you think about why crediting rates are so important, and we're going to look at our longevity of our crediting history in just a minute, but our crediting rates are going to drive, they're the engine of the products. So when are crediting rates important? Well, certainly if I was going to surrender the policy, or rates stay flat, or when rates decrease, I'd want to make sure I've got a policy that has cash value. So if I exited out for any reason, I would get some of my money back. Also, in the event of a death, we want to have flexibility that the product performs in all scenarios, that we're going to always have that death benefit payable to a loved one or trust or an heir. And then if we outlive our no lapse guarantee period, how does that current assumption value work, and will it drive the engine of the product and allow it to outperform over time? This is a real life example, and one that I think is important for us to consider and look at. And this was a look back all the way to 2011. So you can see all those great carriers on the box on the left. You're probably familiar with all of them, and might have over your career sold a lot of those products on the left. But the question that Rod had on the Nelson case, and I think we want to encourage you to think about when you look at product selection, is what does my premium do? What's the value of the crediting rate? And is it worth paying more for a traditional no lapse guarantee? And what do I get for that? And so in this example, we've got a protection UL contract. Again, you could put the survivorship right into it as a paralleled product, but the premium was $26,000, really the cheapest on the page by far. And the question was, over time, will that premium be enough at the crediting rate that you've established for the product to stay healthy and for it to perform past the guarantee, which is typically into the late 80s or early 90s in how we design these products? So Prudential in this circumstance was 33% more. That was Rod's example of the alternate choice carrier in the survivorship case. And what this slide demonstrates, and if you look at that line at the bottom, that's the Hancock premium. Now, why did it start to go up in 2019? It started to go up because the crediting rate inside the product was lowered slightly, but still maintained a competitive rate high enough for it to never be more expensive than the next least price GUL on the market. And because we've increased crediting rates back into the product recently, as rates have risen, that premium with that LifeTrack billing can now ramp back down and start to save the clients on their annual premium because we've maintained that competitive interest rate. So one of the ways we do that is with long duration assets. Really, if you think about our general account, I want you to think of it in two forms. One, your fixed income investments that you're familiar with that all insurance companies invest in, like long duration bonds. Now, the portfolio yield on our general account is going to lag as rates rise back up because we've got very long assets. But what insurance companies did, and what we really did first as a leader in the industry, is we went to other markets and other asset classes that created alternative long duration assets like bonds with higher returns. So we wanted to seek alpha, higher returns than what bonds were crediting, but with a lower standard deviation or lower risk inside the contract. And so we'll look at some of those things now. And it's important to know that if you marry both those two things together, we can maintain a really competitive interest assumption in our contract. So what are some of those asset classes? Real estate, power and infrastructure, private equity. One that's a lot of people don't know is timber. We actually have a really robust timber portfolio, and that's done great for us. Oil and gas and farmland, as well as real estate. So you combine those assets with our bonds and other fixed income assets, and allows us to maintain that really strong interest rate. We are a developer of and manager of these assets. So we're going to markets and developing markets, and we believe that makes us better and more informed investor, which leads to better overall investment returns. So you can see here that right side of this graph talks about those general account assets. What's the world doing in terms of the treasury examples that we look at, the 10-year treasury example, what are the bond portfolios yielding? But these are some of the other asset classes that we've owned, which when you add these two things together, put a really strong story around account performance and cash value growth. This slide's pretty self-explanatory. Green's good. And so what this shows against other carriers in the industry is for that shorter guarantee, but with competitive cash value, how is your contract going to perform relative to its peer classes? Really, you can see very strong product positioning across the industry in both single pay and full pay. And again, these are single life products, but it's available in a second to die version as well. Here's an example about product flexibility. And what I think is important here is that when you compare us to some of the other GUL contracts, they become cost prohibitive if you make any errors along the way. So although protective in this circumstance was really pretty close in price, there were some issues with it performing beyond the guarantee duration. And there's also issues with no lapse products about paying your premiums on time, paying them early, paying them late, and how those affect the shadow accounts and the structural guarantees within the product. So a lot of people like to say you can set it and forget it with a no lapse product. At the end of the day, that's just not true. You still have to be highly involved and make sure you're monitoring the control and the performance of the product. So I just want to I'll throw the sharing back, Tom, if you don't mind taking it off so I can see Rod and his face again. But at the end of the day, we were able to maintain a crediting rate in that product around 5%. We started at 5.2, we're crediting around 5% today. It dipped just a little bit into the high 4s, but we maintained a really high crediting rate inside the contract over the life of the contract since 2011. And what it's allowed us to do is outperform no lapse products because of that cash value growth and performance. Now, I'll just take one step back and reiterate something as I pass this over to Rod. Rod's job is to find the right carrier solution for you. He's asked John Hancock to be on the call today because we will be in the mix and get at bats when your clients have life insurance needs. Does it mean we're the right solution all the time? Absolutely not. But we do believe with the name and the history of our brand, the full portfolio breadth, products like Protection UL is the survivorship version of that, and then value adds like Vitality, we really feel we can compete on almost every case. And you complement that with what I would call our industry leading underwriting or responsibly aggressive underwriting. And those ultimately are going to dictate the carrier and the product solution. So we think if we add all those things together, we can be a provider that earns your business. But I use that word earn very importantly. We don't expect it, we need to earn it. And you got to have all those components leading to a product solution that's going to be ultimately valuable for your client. So we really appreciate the time today. Any case like the one you guys are working on right now is tremendous. It shows that quality planning is happening. And so use Rod as that resource to move cases and have those dialogues and those conversations with your clients, because it's the best time ever to gift assets, and we need to take advantage of that. So Rod, I'm going to turn it back to you.
Beautiful. I appreciate you. Gosh, it's a lot of good stuff. There's always more to do than time to do it. You know, we try to stuff a lot of stuff into these calls. I'm going to take 5 more minutes and wrap us up, share with you a couple of tools that we have. As we discussed, you know, Hancock is great, but we got to have the right kind of conversation, right? And so we have a sheet that I call Who Do You Know? It's called an Identifying Insurance Opportunity Sheet. It lists about 12 different opportunities of how a client might present themselves for you to have a flag that says, I need to talk to them. On page 2 of this, there's 2 that I want you to pay attention to. One we're calling Qualified Plan Maximization. This is really that idea of those with large IRA balances, with or without RMDs being required today. We need to ask them what their plan is for their legacy, how they feel about those taxes, who are their beneficiaries. They have a surgeon son who made $1.2 million last year. That's probably going to be a very onerous asset, and that cost of tax for the son might be way higher than the cost of taxes for the adults or for mom or dad. And so you'd be surprised how many 70 and 72-year-olds buy life insurance for this purpose. Okay, we see it all the time. Down below, wealth transfer and legacy planning. Now, we've been talking about much larger estates, clearly, because of the liquidity of the estate tax. Let's not forget we have some state estate taxes. I'm going to show you a quick diagram on that as well. But generically speaking, if you've got someone over $2 million, especially if they have pensions and Social Security, the likelihood that they'll have dollars to pass is pretty high. And so again, what's important to you about your legacy? How do you feel about taxes? Have you ever considered the impact of a down market, the impact of higher taxes, or something else going wrong? How do you feel about that, right? And so again, clearly this sheet is actually one of my favorite sheets that we have at US Advisors. I could probably spend literally the entire day with you on these 12 ideas, talking about who are the people we should talk to and where should we find. If you want to be serious about writing business, I suggest you reach out to us and take a look at this sheet. Because if you're able to identify 3, 5, even 10 people that you can have appropriate conversations with, and if you're in a high trust environment and completing comprehensive financial plans, it's been my experience anecdotally that as many as 80% of those clients may end up implementing an insurance opportunity if you can identify it correctly. And perhaps you can spend 15 or 20 minutes before the meeting so that you can sort of think about these things. That might be how I would use this. Okay. If you're going to use this, I might suggest that you use it ahead of the meeting that you might put in place. So if you have an estate planning meeting or a risk management meeting, you might suggest, hey, do you mind if I send you this quick questionnaire? Maybe you can spend 15 or 20 minutes ahead of time, and in so doing might sort of get the juices flowing, if you will, and so we can have a more appropriate conversation when you do come in. There is a nice piece. It's from a competitor that shall be named nameless, but even Mike mentioned something about, the lower estates. What I think is really interesting here is that, well, should I worry about this? Well, first of all, if we have qualified assets, we need to worry about it, in my opinion. If we have a illiquid estate because our dollars are in real estate holdings or they're in a closely held business, we need to think about this. But this just shows just quick math. I know I'm talking to wealth advisors, but if we have a $3 million estate today with a 4% growth rate, in 10 years, it's going to be $4.4 million. In 20 years, 6.5. So again, what really intrigued me about Mike's comments was the two things are kind of the same thing. I think he indicated that a number of people are going to be excited. So why don't you go ahead and put on George and Andrew's contact information, if you don't mind. We have our next Coach's Corner for July 20th. That's the third Thursday of each month. Please go ahead and reach out to Andrew or George or myself on your next case. And please make sure that you reach out if you want to see any of these materials. We do have an insurance advisor toolbox that holds all of our best stuff. If you have not seen that, please reach out to us on that basis as well. So with that, I appreciate everyone's time. I'm going to encourage you to be great leaders. Let's help clients and let's drive revenue. Have a wonderful day, everybody.
Everyone, thank you for joining us today.
Thank you all. Have a good day.